So we're going to be looking today at essentially how banks create money, okay? And the way this happens is through this process we refer to as fractional reserve banking, okay? And what that means is exactly what it says, okay? When you put your money in the bank will keep a fraction of your deposits, the fraction of your money on reserve, okay? They'll put it in the vault, okay? The rest of that money will be loaned out to others because, again, the way banks work is they're essentially stores for money. They will buy money from you by paying you interest to deposit your money in a savings account, a checking account, CD. Most checking accounts don't pay interest, some do. And then they will turn around and they will loan that money out to others, okay? So banks only keep a percentage of their deposits on reserve, and then the rest of it gets loaned out. And so what this does is it actually creates new money, okay? And so there is a reserve ratio. The Federal Reserve sets this, and it's one of the three tools the Fed has that can control the money supply. And we'll look at that here momentarily. In the US, small banks can loan out all of their money, okay? They do not have any required reserves. And the reason why is they're small, and if they run out, okay, if they run out of money to fulfill depositors' needs, in other words, you go in to withdraw your savings account, they don't have any money, they can get a short-term loan from the Fed to overcome that, and that will not break the financial system, okay? So, because it's a small bank. Medium-sized banks have to keep 3%. Large banks like Chase or Wells Fargo or PNC or the big banks, they must keep 10% in reserve. And so what this basically means is that small banks and medium-sized banks are able to loan out more of their deposits, and as a result, that kind of allows them to compete a little bit more easily with the larger banks that obviously have more money. So what we have then is that required reserve. That's how much the Fed requires you to keep in the vault. Excess reserves then is anything beyond that, and that money can be loaned back out, okay? So basically, here's how this works, okay? A bank accepts a deposit, okay? And I'm going to take this off present mode for a second so that I can show you my whiteboard here. So a bank accepts a deposit, okay? And let's say the bank gets a deposit for $10,000. Okay, so I get 10,000 bucks. I deposit it in the bank. Okay, if there's a 10% reserve requirement, it will keep $1,000 in reserve. Now, what's going to happen to the rest? The other 9,000 is available to be loaned out. Now, think about this. Okay. Let's say you come in to buy a used car. Okay, so you borrow $9,000. I never advocate borrowing money to buy a car. But anyway, you borrow $9,000. You go buy the car. The car dealership you buy the car from, when you get a loan for $9,000, I give you a check for $9,000. Again, you'll pay that back over the next 5 or 6 years. But what happens then? You take that check to the car dealer. Hand the car dealer that check. What is the car dealer going to do? They'll put it in the bank, right? So they're going to deposit it in the bank. So now we have $9,000 deposited in the bank. Okay? So we've got a new $9,000. Okay? So as a result, the total deposits in the bank are now $19,000. Now, of that new 9,000, 900 has to be kept in reserve. Or, well, hold on. Yeah, 900 has to be kept in reserve. So 8,100 can be loaned back out to somebody. Okay? Now, here's the thing. Your original $10,000 or my original $10,000, is that still showing in my account? as I have $10,000? Yes. The car dealership has $9,000. So that's still showing in their account. So we have $19,000 in deposits. Has any new money been created? Not necessarily, right? But I have $10,000 in my account. The car dealer has $9,000 in their account. Okay. Now, Julie comes along and says, hey, I need to pay for a semester of college. So I'm going to borrow $8,100 to pay for a semester of college. So the bank writes her a check for $8,100. That check then gets deposited, gets handed to the college. The college deposits it in their account. Boom, we add $8,100 to the bank. So the bank now has $27,100 in deposits. Of that new $8,100 that was deposited, $810 have to be kept in reserve, and the rest can be loaned back out. So let's see here. And so we can loan out $7,290. Okay. So basically, through the process of making 3 loans, our new bank balance is $27,100. We have in the vault $2,710 sitting in the vault, and we have loaned out 7,000. We've loaned out all of this money here. Okay, we've loaned out what? $22,390. Okay. That's not correct.
Mr. Smith,
Yes.
if banks are doing this all day, every day, all across the country, how do they keep the money that they've printed and the money that's already out there? Like, how do they make sure there's not too much out there from what they print?
How do they make sure there's not too much out there? Basically, what happens is eventually, with each new deposit, like this original $10,000, we're going to have loaned out enough that we kind of largely know, we will eventually exhaust this. Okay. But this is a part of the money supply. So, how we prevent there from being too much money out there? We raise interest rates. Okay. That's how we do that. Is we do something like raising interest rates. So if the Fed sees that there's too much money out there, there's too much money in circulation because there's too much money being borrowed and spent, they'll raise interest rates to make it harder, therefore more expensive, to borrow money. So, so one thing that the Fed does is they keep an eye on the amount of bank deposits and things like that to produce, or they keep an eye on the amount of bank deposits. So they generally know roughly what the money supply is at any given time. They also know what the inflation rate is at any given time. The money base, which is the actual amount of currency that is out there, okay, is about $4 trillion. Yet M2, which is currency, checking accounts, savings accounts, small time deposits, about $19 trillion. So, but coming back to this here, take a look at at this. Has any new money been created? Not necessarily, right? We're taking the original $10,000 and just through the process of loaning that money out, that money being deposited in the bank, then loaned out again, then deposited again, it has become $27,000 worth of deposits. Okay, so that is how fractional reserve banking creates new money and therefore increases the supply of money. And obviously, we know that an increase in the supply of money is going to lead to a rise in the inflation rate. So those are kind of the 3 steps. So what we can do to figure out how much new money can be created with each deposit, and this will help answer your question, is we know roughly how much new money will be created out of each deposit, and And as a result, we can kind of use that to inform the money supply. Now, this is a maximum. Most banks do not loan out all of their excess reserves. So because of that, we know that the actual amount will be less. The actual amount of new money that will be created will be less. But we have the money multiplier. Okay. So what is the maximum change in the money supply from each deposit? Okay. Your book says due to initial change in excess reserves. Let's put it this way. Out of every new deposit, how many new dollars could be created with that money? Okay. If the reserve requirement is 10% like it is for large banks, the money multiplier is 1 divided by the required reserve ratio. Okay. And the required reserve ratio is set by the Fed. Again, for large banks, it's 10%. So for large banks, because the required reserve ratio is 10%, which is converted to a decimal point 1, the money multiplier is 10. So every dollar that gets deposited into, say, Chase or Wells Fargo will, through the process of loans and deposits, and loans and deposits, eventually become $10 worth of new money. Okay, $10 worth of new deposits in some degree in some bank. Okay, for the smaller banks, the medium-sized banks, their reserve ratio is 0.03. It's 3%. So their new dollar, every new dollar deposited, if they loan out all 97% they're allowed to, could become 33 new dollars. Okay. And so again, the Fed kind of keeps tabs on this, and they use that to influence their decisions on interest rates. Okay. So the actual change in the money supply then is the change in excess reserves. Okay. The amount of new deposits put into the system times the money multiplier. Okay. So as a result, the change in excess reserves would be, let's say, again, from our original thing here, we put in $10,000. Okay. That's a change in reserves times the money multiplier. Okay. Which is 10. So it would be $10,000. Actually, it would be excess reserves. So it would be 9,000 because, if we put 10,000 in, the original excess reserves is 9,000 of that, multiply that by 10, and you have $90,000. Okay. Now, if you want to see a little bit more in depth how this works, your book has a lot of really good mathematical graphical examples of this, very similar to what I just showed you, okay, on the whiteboard, but they go through a number of examples. Okay. Now, in the real world, the money multiplier is actually lower than that. So if you put $1, into Chase Bank, that doesn't automatically mean that it's going to become $9. Okay. Because they'll be able to loan out 90 cents of that. It may become 7 or 8 because most banks do not loan out 100% of their excess reserves. They don't loan out 100% of the money they're allowed to or able to loan out. Okay. So the bank reserve requirement is one of the 3 tools the Fed has to create new money. Okay. And so they create new money through doing one of 3 things. Number 1, and again, I'll jump down to the bottom since that's what we've been looking at here, is raising or lowering the reserve ratio. Okay. If we raise the reserve ratio, that would decrease the money supply. Okay. The Fed really has not done that since 1982. Now, what they'll do is they'll kind of tweak the thresholds by which banks are defined as large, medium, or small banks, but they've not really made a major change in the reserve requirement since 1982, when they were really trying to curb an inflationary problem. So raising the reserve requirement, let's say we raise that from 10% to 20%, that would decrease the money supply because now the money multiplier would only be 5 instead of 10. Okay. because it would reduce the amount of money banks would have to lend, and therefore the process of lending and depositing could not create new money. If we lowered the reserve ratio, that would increase the money supply because it would allow banks to loan out more of their excess reserves. The second is what we refer to as open market operations. The Fed can buy or sell government bonds. If the Fed wants to increase the money supply, it can buy government bonds. It can essentially draw a check on its own accounts. Okay, we would say that's printing new money, but it puts money into circulation that had previously not been. The Fed can draw a check on its own accounts, and they buy U.S. government bonds. So they're giving that money to the U.S. Treasury. And again, the government will pay them back over a series of years, but they put that money in the Treasury, and then the U.S. government obviously spends that money, so it ends up in general circulation. Okay, and so then if the Fed wants to decrease the money supply because inflation is a problem, they can then sell bonds. Okay, and then the third one, and this is the one that probably affects us most every day, is the discount rate or the interest rate. The discount rate is the rate charged by the Fed for short-term loans to banks, usually some overnight loans or very short-term loans. This is also often known as the federal funds rate. The federal funds rate right now is 0.25%. And what that rate is that is the rate that the Fed charges banks, and also banks charge each other to loan money to each other, because as we learned yesterday, the Fed is your banker's bank, so it can loan money to your bank. And so the discount rate is what they charge your bank to loan the money. Why is that important? Because the discount rate is the rate at which pretty much all interest rates are figured. Okay, so for example, the interest rate that your bank pays on your savings is usually keyed to the discount rate. It's going to be usually fairly close to the discount rate because it's actually more risky for your bank to pay you interest on a savings account than it is to just borrow money from the Fed, because it knows when it can pay the Fed back. You can withdraw all your savings account tomorrow. So they'll pay usually slightly higher interest on your savings than the discount rate, but not much. Right now, by the way, that rate is 0.25%. So if the discount rate went up, the interest rates on savings accounts would also likely go up. However, the interest rates on loans also go up. And so that would make it more expensive to borrow money. Therefore, fewer people would borrow money. Therefore, you would have kind of a slowdown in the economy. Obviously, then as well, you would curb inflation. And that's why we would raise interest rates, is to slow inflation. And also why we would sell bonds or raise the reserve requirement. And so, let's say, we raise the discount rate to what it was a year ago, which was 1.25%. Well, the price of a home loan usually is about 2 to 3% higher than the discount rate. So let's say it's 3% higher. So a home mortgage right now that might be 3.25% would go up to 4.25%. Okay, and that's a lot of extra dollars that have to be paid back over time. Okay, so that's essentially how interest rates work. So the Fed can set that discount rate, and then all other interest rates are kind of based off of that, again, based on the riskiness of the loan and the time, or the liquidity, the time required to pay that back. U.S. bonds, right now, U.S. bond rates are about 1 to 1.7%. They often, they're traded on the open market, but their interest rates are often influenced by the federal interest rate as well, because they're going to pay obviously a little bit higher than a bank will pay. Pretty much all interest rates derive from the discount rate, although interest rates by and large are set by supply and demand as well. And so as there is a greater demand for money, that will eventually drive interest rates up. And so what the Fed often does is, if it sees interest rates going up, in the market, it may lower the discount rate to try to drive them back down to encourage economic growth. Okay. Anytime we increase the money supply, the reason we're doing so is to boost aggregate demand and to bring about economic growth, and to keep unemployment low. But the trade-off is inflation. The prices are going to go up when we increase the money supply. Anytime we decrease the money supply, we curb inflation, but the trade-off is at the expense of slowing economic growth and usually dealing with higher unemployment. And so as a result of that, the Fed tries not to decrease the money supply unless inflation is going to be a problem. And usually what the Fed's trying to do, because they're trying to balance inflation and unemployment, is they try to kind of thread the needle there to keep the money supply at a point where inflation is always going to be at about 2%. Now, the article you read yesterday, we found out that no, not necessarily. Right now they've been targeting 2%, but we know that some of the Fed governors, the Fed bank presidents, are actually maybe willing to let inflation go a little bit higher than 2%. Okay, maybe to 3%, maybe to 4%. Hopefully not 4, but maybe allow it to float it closer to 3% to kind of foster a little bit more economic growth because of the kind of economic wildness we have had due to the pandemic recession and the kind of the ups and downs of that.